Hey everyone, welcome back to the IX channel. Today we're diving into the fascinating world of derivatives markets. I know, derivatives sounds like one of those boring finance words, but trust me, this is way more interesting and crucial than you think. So buckle up and let's break it down to something simple, relatable, and even a bit fun. Alright, first off, what's a derivative? No, it's not some complicated math formula. Well, not today at least. A derivative is just a contract. Yeah, like a legal agreement. That gets its value from something else called an underlying assets. Think of it like a side bet on something you don't even own, but you're trying to predict price will move in the future. Now, this underlying asset could be a stock, a bond, a commodity like gold or oil, even interest rates or currencies. Basically, anything with a price that can go up or down, and you're not trading the asset itself. You're trading a contract that says, I think this price will go up or I think it will go down. Simple enough. Cool? Let's keep going. Now, why do people even mess with derivatives? Great question. Two big reasons. You use derivatives to protect yourself from price changes, like putting on a raincoat when you think it might rain. Speculation, or if you're feeling adventurous, you use derivatives to try and make a profit, kind of like betting that your team will win the big game. One's about playing it safe, and the other's about taking a risk. So, what kinds of derivatives are there? Let's talk about the four big ones. Futures, options, swaps, and forwards. These are the tools traders use to hedge or speculate, but don't worry, I'll explain each one without the fancy jargon. First up, futures. A futures contract is like making a deal today to buy or sell something in the future at a price you both agree on now. Think of it like this. You know you're gonna need coffee in 3 months. You don't want to risk coffee prices going through the roof, so you make a deal today to buy at today's price, no matter what happens later. Even if prices skyrocket, you're safe. You pay what you locked in. Pretty sweet, right? The catch? You have to follow through on the deal. It's not optional. Futures are like a firm handshake deal that you can't back out of. Next up, options. Now, options are like futures, but with one huge difference. You don't have to go through with it if you don't want to. You pay a little upfront to buy yourself flexibility. There are two kinds of options. A call option gives you the right to buy something at a specific price. A put option gives you the right to sell something at a specific price. Here's how it works. You think Apple stock might rise from $150 to $200. Instead of buying the stock outright, you pay $5 for call options that lets you buy at $160 if it does go up. If Apple hits $200, you're golden. You get it for $160. If it doesn't, you're only out of $5 you paid for the options. It's like reserving your ticket without fully committing to the concert. Now let's talk about swaps. These are basically agreements to swap things, like cash flows or financial obligations. The most common type, interest rate swaps, sounds fancy, but it's really just two parties agreeing to exchange the type of interest they pay. Let's say company A has a loan with a fixed interest rate. They pay the same rate every month, and company B has a loan with a variable rate. It changes depending on the market. A expects interest rates to go down, so they want a variable rate. B expects rates to go up, so they'd rather have a fixed rate. They swap their interest payments. A gets what they want, B gets what they want. Win-win, or at least that's the idea. Finally, we've got forward contracts. These are basically the DIY version of futures. Private deals that aren't traded on exchanges. It's like if you and your buddy make a deal. Hey, I'll buy this from you in 6 months at today's price. You customize everything. The price, the terms, the delivery date. It's totally between you two. No exchange, no public market involved. But be careful, because forwards aren't standardized or regulated like futures. It's just you, your counterparty, and the terms you've set up. Okay, so why all this matters? Derivatives are super important because they let companies they manage risk and stabilize prices. For example, airlines use derivatives to lock in fuel prices. Farmers use them to make sure they won't get screwed by a bad harvest season and falling prices. They also help markets figure out what things should be worth in the future, which is valuable info for investors. Of course, there's a flip side. Derivatives can be super risky because you're often leveraging or borrowing money to control bigger positions. Small changes in prices can lead to big gains or big losses. It's like using a small amount of money to control something much bigger. If the market moves the wrong way, you could lose more than you put in. We saw this in the 2008 financial crisis. A lot of risky bets on mortgage derivatives went bad, causing banks and financial institutions to lose billions. So yeah, derivatives are powerful, but if they blew up, they can really blow up. So to wrap it all up, derivatives are these really cool and sometimes dangerous financial contracts that let you bet on future prices without owning the actual asset. They are used to manage risk or take on risk, depend on your strategy. Futures, options, swaps, forwards, they all have their place and they keep the financial system running smoothly most of the time. But like anything in finance, you've got to know what you're doing. Thanks for watching. Drop a comment below if you've got questions or if there's another finance topic you'd like me to cover. Don't forget to like and subscribe. May you always be in the green, both in your bank and in your life. I'll catch you in the next one.